Let's talk about risk, baby. Let's talk about you and me. Let's talk about how risk comes up in your portfolio. I don't know, something
To
like
save
that.
you money.
There we go. Let's go.
He is feeling it after all.
Yeah. So if you haven't guessed it by now, we're going to talk about risk. We're going to start off with defining different types of risks, how we manage risk, how we measure risk, and how we come up with a risk tolerance.
Mm-hmm.
Yeah.
And this came about because I think right now people are asking about market downturns. They're seeing their portfolios lose value. And so some of them are commonly asking, hey, James, if I can get 4% on the money market, for example, why should I be invested in stocks when they're losing? And so I think people think risk, I might lose all my money.
Mm-hmm.
We don't really see it that way. We define that as market risk. And that's just one risk. There are many other different types of risks that we need to be aware of and manage towards.
Mm-hmm.
So most of those risks can be categorized under systematic risk and unsystematic risks. Can you all define those two categories and give us examples of each?
So we would classify systematic risk as market risk. That's technically, when it comes to investing, that's how it's defined. And so a couple different risks that fall underneath that category would be liquidity risk, interest rate risk, inflation risk, geopolitical risk. We also consider
Natural disasters, right?
Yeah, fiscal and monetary policy as well. Those things affect industries across the board. So you cannot diversify against that. There's no way you really diversify that risk. Unsystematic risk is risk associated to a specific industry, business, or an organization. So that you can diversify away from, right? So let's define a couple of those systematic risk, right? So one we talk about is interest rate risk. So if we think about really what's been going on over the past couple of years, because we're coming off of a high inflationary time frame, what's been going on is the Fed has been adjusting interest rates up and down. And so when that happens, that has direct impact on consumers from a borrowing aspect, right? Has direct impact on businesses to lend and as lenders and lendees. And so that affects multiple industries, not just one specific industry. We think about inflation risk, so the risk of the cost of goods and services going up. That affects everybody. You know, the cost for us to purchase something, the cost for us to utilize a specific service for businesses and consumers, that can then influence individuals to spend less and purchase less. So that's another specific type of risk. We talked about liquidity risk. Liquidity risk is also something that if you think about a specific asset that you have, and it's very difficult to turn into cash. So perfect example is real estate. So the risk of the market and having too much inventory in the real estate market where there's not a lot of purchasers, right? And there's a ton of inventory, well, it becomes very difficult to then liquidate your real estate asset and turn that into cash.
A lot of those are economic things though, right?
Yeah.
So
yeah.
how do they apply to somebody's specific investments in their portfolio?
Yeah. So specific from a portfolio aspect, right? If you think about interest rate risk, that affects bond pricing, right? So interest rates go up. Typically that affects the price of your bonds in your portfolio. So that fixed income asset in your portfolio could be at risk and would be at risk across the board. And that's all bonds, whether they're short-term, intermediate-term, long-term, they're all affected in some way by interest rate risk.
Even your CD borrowers too, right? Because you have a lot of individuals that like to rely on conservative holdings to, try to avoid market volatility, do different things, or they rely on that as income. And so even that becomes a risk, right? How long do you buy those CDs for, right? For many people that just went through, COVID, where interest rates were at all-time lows, right? Those were times to take advantage of low rates if you were the borrower, right? So if you had a mortgage, right, you saw a lot of refinancing happening during that time frame. Now we're kind of in a little bit more of an awkward period where rates are starting to rise. Then there's conversations about them coming back down. There's a lot of uncertainty where rates are going to be. And so for some of these individuals that are using some of these conservative holdings, right, Now there's we call it a duration risk, right? How long do you need to have these CDs? What's the right time frame before, rates go one way or the other and you're kind of on the wrong end of that?
Okay, since you brought up CDs, can you talk a little bit about call risk and reinvestment risk?
Yeah. So, there are different types of CDs, right? There are bank CDs where you typically will hold them for a term, right? 3, 6, 9, 12 months, 15, 2 years, 3 years, right? They have different time frames. We utilize a lot of brokered CDs. And so those CDs will have similar time frames, but they will also have these little caveats in there where they can actually redeem them at earlier times. So therefore, you may not get that higher yield for a longer period of time. They may cut it short. And so, when you have those type of things that happen, right, now you have a time frame where they're taking advantage that rates have been more favorable for whoever was lending you the money or whoever was giving you the interest. Now that they've already paid off your CD and they don't have to continue at that rate, they can now offer you at a lower rate. So therefore, as the person that was trying to receive that income, now you have a choice, right? Do I take the lower income or you have to find another alternative?
Okay, and this doesn't apply to just CDs.
No, this applies to bonds. This applies to, I'm trying to think what else it applies to other than CDs and bonds.
Yeah, I guess what I just wanted to establish, it applies to all fixed income.
Yeah.
Correct. There you go.
Yeah. And again, just to reiterate, so with that example, right, a lot of people are wondering, hey, why would I put my money in something that's losing when I can get 4% guaranteed?
Yeah.
Well, a lot of the reason why is because that money market is tied to short-term interest rates that may or may not outpace inflation.
Right.
So you do need a little bit of market risk in your portfolio to reach your goals.
Right.
Yeah.
Okay.
You got to pick your poison. There's so many risks and you have to look at your situation and assess, which risk are you most concerned with? Like James mentioned, you might be concerned with the markets right now, but longer term, how's your purchasing power? The last few years, post-pandemic, we've been talking about that we haven't seen this type of inflation for decades. So longer term, you have to really analyze, do you have the required rate of returns to make sure your hard-earned dollars today are going to be able to keep up in the future?
Okay, I want to unpack that a little bit later.
Yeah.
But let's talk about how we measure risk, because I think risk it could sound like this subjective term, and I feel like things that aren't defined, you can easily be fearful of them.
Right.
So I feel like if we can put a specific measurable, could help tame some of those fears.
Yeah.
So how do we measure risk, or how is risk measured?
Yeah, one of the measurements that we look at a lot in explaining the ups and downs of investments is standard deviation. And this simply looks at, when you look at any investment, is you're looking at how narrow or how wide are the returns of that investment. How much does it go up and down? And, it's one thing to say, oh, this investment gave me 10% return, but how did it get there? Did you have an experience where every year it was 10%, so the average is 10%? Or is it one of these where it's swinging negative 30 to up 30? How did you get to that 10%? And we look at standard deviation to explain that risk. And so it starts by looking at the mean or the average return of that investment. And then you're looking at how widespread those returns are from that average.
A good example, let's say an investment averages 10% over time, and it has a standard deviation of 10, right? So there's a probability scale where we look at 1 standard deviation, 2 standard deviations, and 3 standard deviations. So an investment that averages 10%, there is a 68% chance that investment's going, within 1 standard deviation, that investment's going to either earn 20% or be flat. If we go out 2 standard deviations, that's a 95% probability. So a 10% on average return for that investment, there's a 95% chance that investment could be up 30%, or that investment could be down 10%. You go out 1 more standard deviation 3, that's a 99% probability range, meaning that that investment has a 99% probability of returning anywhere from positive 40% to negative 20%. So that example we use when we determine standard deviation, the probability is high when you look out 3, extremely high, 99%, 2 95, and then 1 at 68. And so that's a good way for you to kind of gauge and measure, what is the upside potential and what's the downside risk to the specific investment.
Yeah, you can look at like the S&P, for example. Depending on which day you look at, the 10-year average return, I think, is 10%, and it has a standard deviation of 15 to 17%. And so if your average return is 10, that means you can the standard deviation you can have, you can be up 25% or down negative 5%. And that's going to be, the dispersion of your returns to get to that 10%.
Yeah, I want to belabor a point for a second. Yeah. So just using those numbers. So let's say it is 17. Standard deviation is 17.
Right.
On the high side of
on
your
the
range.
High side, yeah.
So 3 standard deviations. So was that 3 times 17 is that 54?
Yep.
51.
Or 51. 51.
Yeah. Mm-hmm.
So I have a 99% probability that if the average return is 10% minus 51, so on the low side, 99% chance that it's going to be within 41% down.
Mm-hmm.
Okay. Yeah. I kind of think that's important to wrap our heads around, because I think in times like this where things look really scary, or like in 2020 when we had a pandemic and people think that their money's going to go to zero.
Right.
That could happen. Very unlikely. Statistically, probability, right? 99% versus 1%.
Right.
So I think that's important.
Oh yeah.
Yeah.
I always think it's interesting too, right? On just the time frame, right? Because I don't throw off too much, right? But short time frame, right? Things look very, very rocky, right? But you go back 12 months from right now, things look still pretty good. And so I think it's always kind of putting that in perspective for people. But I think giving them a chance to understand that we actually have a process should help them understand that, hey, we have an idea, right? We know that there's a high probability we're not going to zero. We know that the worst case scenario is, a 40% negative blow, right? That's worst case scenario. And if we've done certain things, right, we can reduce that quite a bit. And so, I think most people are not invested 100% equities. And if they are, they kind of understand that risk. And so for a lot of the people that have the concerns are typically your older individuals that have maybe more fixed income, other investments other than just stocks. And so you can kind of help them understand that by being that extreme that, hey, things are maybe not the best right now, but they're not as bad as you think they are.
Yeah. To that point, for all the DIYers out there or the people that want to understand investments a little bit more, simply put, the higher the standard deviation, the more volatile it's going to be.
Right. Mm-hmm. We use standard deviation. Standard deviation can be utilized for any risk, whether it's systematic or unsystematic. We use beta to measure systematic risk, right? That's how we determine stock or a stock fund is how it's in relationship to the index or benchmark that it is comparable to. On the unsystematic side, we use alpha, and we didn't really get a chance to define some unsystematic risk. We discussed systematic risk as something you really can't diversify against, right? Everybody and everything is affected by it. Unsystematic risk, you can.
Can you give us some examples?
Of unsystematic risk?
No, systematic. Like I know you gave us some terms, and you said you can't diversify out of them.
Right.
Can you give us an example of a specific risk that you cannot diversify out of?
Yeah. So specifically, we're talking about interest rates, right? So the risk of interest rates changing affects all fixed income, and it affects businesses as well too. So you cannot diversify against interest rate risk. You just have to understand that there is risk associated to it. How do we manage that risk when it comes to systematic, right? Unsystematic is different in the sense that you can look at a specific sector, specific industry, or specific company and identify risk with those specifically, and then diversify away from those. So companies, one of the examples I like are companies that are data or internet dependent. And if these companies aren't aware of potential cyber security issues, then there could be massive data breaches, what then affects that company individually. Then you have consumer sentiment issues with that company. Also could affect their actual financials as well too. But you can diversify against those, understanding like, hey, that is a risk with those specific industries, those companies. We don't have to invest in that specifically, right? What CFAs do is they analyze the financial health of these businesses. So when they're doing portfolio construction, they're looking at, their financials, their debt, their everything when it comes to the accounting side. And you can determine a healthy company or a not healthy company financially and not invest or invest away from those types of companies. And so we use alpha to determine the level of risk associated to unsystematic risk, but it's something that you can be aware of and say, hey, that risk is out there. My portfolio doesn't have to be affected by that whatsoever.
Yeah, I like the example you used because the first thing that popped in my head was the incident in summer 2024 with that cybersecurity company.
Yeah.
And there was an outage
Yep.
and it impacted a lot of people and it also impacted the company.
Correct. Right. Yep.
I think it was like airlines, right? That just kind of went through these. Well,
Yeah, we're going to stay away from said we're not going to name names. Somebody can Google that if they want.
or industries, right?
Yeah. Okay. You mentioned alpha measuring unsystematic risk. Is there a way to measure systematic risk?
Yeah. So beta is what we utilize to measure systematic risk. So what we're doing is we're determining whether that specific company or that specific fund is taking on more risk in comparison to its benchmark. So if we look at a specific U.S. growth fund or a U.S. blended fund and the index is the S&P, we take beta to determine if that fund is taking on more risk than the benchmark that we're measuring it by.
More systematic risk.
More systematic
More
risk.
market risk.
Correct. Yep. Correct.
And the beta is usually is 1
Right.
for the market and then to determine if that security or investment is taking on more risk. If it's less risky, it would have a beta less than 1. If it's more risky, it has a beta more than 1.
Yeah, I always find it interesting, right? A lot of times DYIs or even sometimes clients that are messing with their 401ks, they always pick accounts or funds with whichever one did the best last year. And I always tell myself, we're always trying to find the best return with the least amount of risk. Because you have some of these different funds that are out there that look really good, and then you realize how much risk they were taking on in order to achieve that. And you might find something that's pretty comparable with a whole lot less risk involved. And so you start looking at those, and when you're trying to make up these portfolios.
Yeah, so this may be an oversimplification, but I usually like to say, we've all heard the saying, the greater the risk, the greater the reward. So theoretically, the higher the standard deviation, the better return I should get over a long period of time.
Keyword should.
Yeah, exactly.
Keyword should.
My words were chosen very carefully. So with that being said, okay, how do we manage the risk? We know how we've identified some of them. We've identified some measurements of risk. How do we manage that risk? Like you mentioned earlier about being able to diversify unsystematic risk out. How do you do that?
It's just analyzing and understanding where the risks are in those specific industries or specific companies. And then, you can eliminate or remove those specifically out of your portfolio, right? And understanding like, hey, there's high levels of risk because of X, Y, and Z with this company or this specific industry, and say, okay, we're just not going to.
But our practice specifically, we don't really advocate for that, right?
No,
we don't really exclude.
No. So, for us personally, we're investing in quality in general, right? And so the idea really is how do we manage systematic risk as a whole, and understanding like from an unsystematic aspect, we're putting our faith and trust in portfolio managers that they're not investing in companies that have high unsystematic risk anyways. Really what we're trying to do is we're trying to manage systematic risk, right? We can't diversify out of it. It's just understanding what systematic risk is and really trying to diversify and use asset allocation to manage that risk within our portfolios.
Yeah, sticking to the basics, make sure, we use asset allocation, making sure we invested across different asset classes. Mm-hmm. And that's what we stick to, and we do rebalancing to maintain that allocation So that's a good starting point.
Asset classes, right? Duration, different sectors we're utilizing geographically. We're diversifying geographically as well too. Because right now you think about a lot of the geopolitical issues that are at hand and the direct impact that it has on all industries as a whole. So it's understanding, hey, if we can diversify geographically as well, we can reduce that risk, even though that risk is abundant in many aspects. It's being able to manage that and reduce that as much as possible.
Yeah. So for all you DIYers, if you're concerned with unsystematic risk, because you only have a handful of stocks, if you want to diversify out of that unsystematic risk, consider 20 to 30 different stocks to diversify that unsystematic risk out.
Well, also across different sectors.
Yes. Right. Yeah. You don't want 20 or 30 stocks in one specific sector. I guess there's a little bit of diversification, but still not ideal, right?
No. Correct.
That's a good point, Alexis.
Yeah, you have to kind of manage your expectation. Which risk are you trying to avoid or prevent? Because in this scenario, you are investing across asset classes, which is good. So if one sector is, taking a beating, at least you have other sectors that can help manage the portfolio. But if you're trying to maybe manage downside risk, then you have to look at correlations of your different investments. So,
I love the
There it
fact
is.
that you said that.
That was that was on the tip of the tongue.
no.
Okay.
Yeah.
All right. What are correlations? What does that mean?
What are you trying to do is look at how your different investments move in relation to each other. Because it's one thing if you're diversified, meaning you do have, let's say, the 25 to 30 stocks, but in every situation, generally speaking, they're all moving in the same direction. And so you're diversified, you have multiple holdings, but if you have systematic risk and you're expecting that you're diversified and you're expecting them to move in different direction, you might be surprised if you didn't look at the correlation of those investments that, they're going up at the same time and they're going down at the same time. So I was trying to manage my downside risk, but I failed to do so. Mm-hmm. And so you have to look at the relationship. For example, fixed income bonds have a lower correlation to stocks, so they don't move in the same direction. And correlation is measured by -1 to 1. So if two investments have a correlation of 1, that means they move in perfect positive correlation. If two investments have a -1 correlation, that means they have a perfect a negative correlation. And so that's the spectrum you want to look at if you're trying to manage, downside risk, and you want things to move in different directions.
So in other words, if you have two funds, you got two funds to diversify,
right?
And they're both have a correlation of 1,
right?
You're not as diversified as you think you are,
right?
I think another fun fact is that we established that high standard deviation means high risk, but you can have two high risk investments that are negatively correlated, and you can bring the overall risk of the entire portfolio down, even with two high risk investments. Right. I think that's pretty interesting.
Yeah.
There can be no correlation whatsoever, and that adds an element of diversification as well too, where it's just like, hey, these have nothing to do with each other. One has nothing to do with the other one, and so understanding that, at times they could move together, at times they could move inversely, at times they can move sideways. Like there's that adds a different element of diversification as well too.
There's no magic pill, obviously, but these can be measured. Earlier I just mentioned that fixed income and equities have a low correlation, but if you can pick out like a year like 2022, when the Federal Reserve is increasing rates. And generally speaking, when in an environments where rates are rising, the correlation between fixed income and equities, they do get closer and closer. But for the most part, in most environments, fixed income has a lower correlation to stocks. So,
I'm glad you said that. If I were a cynic, and I were to ask you if correlations increase during times of market distress, why should I even diversify?
Yeah, because longer term, the longer term purchasing power for most, if not all of our clients, unless you take enough risk, it's going to derail your purchasing power longer term. Inflation is a constant. We could be in a low inflationary environment or high, but it's a constant. And what we found, and I think we've mentioned in other podcasts, is one of the biggest risks to making a portfolio last is not taking enough risk. So short term, it feels terrible. And this is a situation where we always have to kind of educate clients why we're doing this and showing them in different ways, whether it's charts or just talking, hey, longer term, this is what happens with these investments. And one of the biggest risks we found is you can look at, it's especially in times of inflation, is that if you don't take enough risk, it's the biggest risk to not having enough money during retirement. Yeah.
Safely losing money.
So I want to segue into the next topic based on that. But before we do that, I want to admit something. I want to confess something.
Oh no.
I was that cynic that asked that question many years ago.
Yesterday?
In case y'all haven't figured it out, it was me.
Yeah.
And what I came up with is that even if correlations are high, standard deviations are still different. So for example, you mentioned stocks and bonds moving in tandem in 2022, both going down, but bonds went down less because they carry less risk. Their standard deviation is less. Yeah. So hopefully, even though the correlations are high, they're not falling by as much.
Yeah, you're not going down with a full 41.
right. Yeah.
There's a little bit of
only
a 31.
Keyword is hopefully.
I mean, 2022 was such a rare scenario in which we had such unprecedented changing and increasing in interest rates that, equities were affected because of the leveraging that they were utilizing. And then obviously bonds have such a direct impact with interest rates. So you don't get that correlation with them that often. You don't get that, wow, everything is down.
Well, yeah, you normally don't get rates that low either, right? So I think that's like an anomaly, right? I think when you look at just
all coming off of COVID, right?
Correct, right? So, those type of things happened. And I think those will be hopefully once in a lifetime type of deals, right? Because I think there's some people out there that had extremely high mortgage interest rates, right? So they remember those times. Rates are kind of where I think they should be, right? I'm not a interest analyst, but a bond analyst. But at the same time, you realize that we were blessed for a little bit there.
Yeah. My old man would say, hopefully insured, famous last words.
But the thing is, I don't know, if we're in a really low interest rate environment, that means we're dealing with a lot of economic distress.
Yeah, something bad happened.
That's the only reason why we have rates down, is because we're dealing with very difficult economic times. So the Feds are only going to lower rates to that level to help alleviate, some of the spending issues and things like that we would see with lending and things like that time frame. So we don't necessarily want or hope that that's the case, because that's really the only reason why we get back to those interest rate levels. So there has to be some balance. There has to be balance.
Balance. Great segue.
Hey.
You mentioned about you have to take on some risk if you want to reach your goals. How do you assess the risk tolerance and how much risk you should be taking on?
10 questions.
Say more, sir.
Fill out this survey.
Well, I mean, that's kind of how we got started, right? And when we first got into the industry, kind of go through this very generic 10 questions. They'd answer that. You'd give them a score and be like, you're a 3, you're a 4 on a 1 to 5 scale. And then you kind of went through that process with them, and okay, yeah, sure. And then, you start kind of working a little backwards, start doing some actual cash flow, some different analysis to kind of feel like, okay, is that where you should actually be? But at the very beginning, it was 10 questions.
He's speaking for himself.
Bite your tongue, sir.
Okay, so is that a good way to do it? Is that a bad way? You said that was what you did at the beginning. What are you doing now?
Asking a lot more questions. And
so now you're up to 11 questions. Is that what okay.
I find it, I found the questionnaire tricky. Everyone's different.
How you phrase the question sometimes can impact how the person would answer.
Yeah, exactly. And so for me, I gravitate more to the math side, right or wrong. Meaning, Alexis was talking about, doing an analysis. meaning trying to get to a required rate of return and going backwards.
Yeah.
Like meaning
It's a lot easier that way.
like Mr. and Mrs. Client, based on your objectives, this is the required rate of return we're going to need to reach those goals.
I can't spend $20,000 a year with a 3% return.
and then going backwards, meaning this is the type of portfolio or allocation that's needed to get that return at a higher probability, and then showing them the standard deviation of that portfolio, the good and the bad, and then you kind of take it from there, and then you need to have experiences together. Quite honestly, meaning, Mr. and Mrs. Client, we had a good year. How do you feel? Of course, fantastic. What about this year? We had a bad year. How you feeling? And then you kind of just take it from there, make adjustments, but making sure that the client can handle the portfolio that they have, but then keeping them on track at the same time. So,
Okay, so what do you do if you give them the required rate of return and they look at the type of portfolio that's necessary and they're like, I can't handle that level of risk?
That's where you got to give them options. You can either, for example, save more, wait a little bit longer if we decide to take on less risk.
Or spend less.
Or spend less, yeah.
Is that the only way to do it? So what I'm thinking about examples where you tell a person like your required rate of return is 0. Like you don't have to do anything.
Yeah.
So how do you determine the level of risk you're going to take on in that type of portfolio?
Those situations are awesome because you can go either way. And at that point, the client can decide whatever they want to do, but you still have to ask them, if you go this route and not take any risk, are you okay with having the same or your portfolio slowly going down? Or do you want to try to have a little bit left over and you kind of just have that conversation and then make a decision? Yeah.
Yeah. Going back when we would do those RTQs,
What's RTQ?
Risk tolerance questionnaires. And with those
in the biz,
with those RTQs is always interesting because like to explain a situation and ask how a client would react at that moment when it's not actually having any impact on them whatsoever. They're from an emotional aspect, they're like, yeah, I wouldn't do anything if my portfolio was down 25%. I'd be fine.
And then it happens in real life.
Yeah, and exactly. And then you go through, downturns, and you go through high volatility periods, and emotionally it affects them completely different than what they would assumed it would, right? And so that's the importance of understanding like, hey, we're going to take on as much risk as needed based on the analytics.
I think also it's important to understand your client, right? Because sometimes their emotions change as time changes, right? So sometimes they kind of fluctuate based off of various factors, just things that might be going on with maybe their parents or their kids. Things change where you kind of start that process as far as where their risk should be. Based off of whatever it is that you've established, as they age, you sometimes have to go back and recheck that a little bit because I think sometimes that changes on them based off of external factors that they don't always tell you, right? You have to ask.
Yeah, because you always have to still you have to be objective and still talk about their options, even in a situation that James mentioned that they don't have to take any risk,
right?
Because you don't have to take any investment or market volatility risk. But if we decide to put everything under the mattress, you would still be good, Mr. and Mrs. Client, but your purchasing power is going down the drain.
Yeah, the inflation risk.
Are you okay with that, James? I hate the market that much. I'm good, fine. Or you know what? I'm going to take on a little bit just to make sure I maintain my purchasing power. So you got to have that conversation and really ask the right question.
Man, I'm glad you said that because I don't want it to be lost upon us that even putting all your money in cash to where there's no level of volatility, no market risk, you are still accepting a risk.
Yeah, big time.
And that risk is inflation risk,
big time.
Purchasing power risk.
Yep. Yeah. Yeah. We see it too now. Clients go through all different types of market environments and they get more comfortable with risk. They really do. And so, early on, and I have multiple clients who, we talked about it before, their thought power is like, their mindset was, oh, I'm taking on risk. I could lose everything. Like it all could be gone. And now that they go through, the market, situations and the environments that they've been through, they realize like, oh, it can't just all go away. It's not going to all just go away. Like, and they become more comfortable taking on more risk because they understand, what the benefits are, or what they should be.
They've also been on the journey with you, right? I call it a little bit of a roller coaster ride, right? And they realize that roller coaster ride typically goes more up than it goes down. And so I think that makes it a little bit easier for them to kind of stomach some of these volatile times.
You know what's so awesome? I was like, man, I'm so proud of this guy for using the journey word, and he avoided roller coaster. And the next thing I know, roller coaster.
Normal.
Yeah. So, man, good stuff, guys. So, y'all defined risks. We talked about how to measure risk, how to manage risk, and how we assess risk. So, I hope that was helpful for everyone. Thanks for tuning in to another episode of Our 2 Cents on Your Dollars.